Hey everybody, good to be here today. My name is Brent Moores and time for Advanced Option Strategies. Today I'm going to continue our series that we started last week on Advanced Option Strategies, but I don't want to ignore what's going on in the market, so we'll address that at the front of the show, but then I want to get in with the real subject, and it's going to be a strategy today which is kind of more on the basic realm of the Advanced Option Strategies I don't know, pantheon here. It's the long verticals, but I think it's a key strategy as you move on to other advanced option strategies. You need to know this one. So we're going to go to that, and I want to talk about some of the different, guidelines you may use as you're trading long verticals. Now, I'm joined in the chat with Barb Armstrong, who's helping me out today. She's a wonderful resource on this. And so as you have questions, she's very familiar with the strategies I'm going to be covering today. So as you have questions between Barb and myself, we'll do our best to help you out. And I see some familiar names in the chat. Glad you're here. And if you're watching on a recording, that's great too. You can follow Barb or myself on X at Brent Moores CS, at Barb Armstrong CS. And let's go through a few disclosures and we'll get to the subject at hand. Options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only. It's not an individual recommendation of any security strategy or chart pattern. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money application is provided for educational purposes only. I may not factor in commissions in all the trades I do today, but just realize they are a factor that you need to consider. All investing involves risk, including potential loss of principal. Short options could be assigned at any time up to expiration, regardless of the in-the-money amount, and stop-loss orders do not guarantee an execution at or near the stop price. There we go. Here's what, I want to just kind of mention the market here to start. Obviously, you guys know what's going on in the market. I wanted to give you a little perspective on this. Now, you may be looking at this graph here, and this is a longer-term graph. This is a 10-year graph. And it can be a little scary sometimes when you're in a market that's dropping like it is, but I want to give you a little perspective. This is where we are right now in the market. If I go back so we've dropped quite a bit here, but this gives you a little perspective of where we've come from. And yes, we're near where we were in 2024. Okay, here's your years down here. Here's 2024. But that's where we are. We're not back where we were all the way in 2022 or 2023 or before then. So given the grand scheme of things, yeah, we've dropped, but drops do happen, don't they? We saw that there. These drops do happen occasionally. So I think sometimes when you're in the midst of a moment, whether it's stock market or anything else in the world, this is something I try and get across to my kids at times. Sometimes in the midst of the moment, it can seem worse than it is, perhaps. Let me zoom in here. Let me go to a 6-month chart, and you can see that drop. What do we want to see here? Well, from a short-term perspective, for strength, and again, this is short term. I've switched to a 6-month chart. What you typically like to see is you like to see a bounce of some sort. So if this is today's candle that we have right now, what we'd ideally like to see is us closing the day up closer to where we opened the day. That would be more, so a candle that looked probably something more like this. This would be kind of like more of a hammer candle right there. And that can be a sign of, hey, we've tested these lows down here and we rebounded off those lows. Now, I don't know what's going to happen, of course. You can go to an intraday chart and see what's currently going on, but that can also kind of drive you crazy. If you want to, you can. But you can see right now we've been going up a little bit, but I was thinking that way earlier this morning, and then, we resumed down. And it wouldn't surprise me if we went resume down again at that point. So my point being, though, we'd probably like from a shorter term perspective, in terms of looking for that shorter term turnaround, we probably would like to see a close closer to where we started the day than the low point of the day. One last thing on the market, and then we'll move on to our subject at hand. And that is, you know, I don't know where the market's going to go. I don't know how much further down it's going to go, but I have been through a lot of market corrections. I've been in the market for many years, over 30 years. I've been in the stock market, and there's been times when I didn't know where the market is going to go. But it has turned out okay in the past, and I do believe it will turn out okay this time around, but I don't know where it's going to end up. Okay, let's get to the subject at hand, though. I want to talk about long verticals. I want to go through the basics of long verticals, everybody, and I want to go through some example trades to kind of illustrate what I'm going to be teaching today here in terms of long verticals. We'll use example trades on that. Let's just kind of talk about long verticals, and I'm just going to use a Word doc here. So here, so just some of the basics. I'm just going to kind of list out some information here, and then we'll go to kind of practical implementation. Although in this case, you know, I want to make this as practical as possible. So I'm going to give you perhaps some guidelines that we'll use in this class. These aren't absolute rules that you need to use, of course, but just kind of how we manage long verticals in this class. There's calls. They can be made of calls or puts. And a long call vertical is bullish, a long put vertical is bearish. And both, whether you're doing a long call vertical or a long put vertical, you're going to buy one contract. And typically, the way we're going to do it in this class is we're going to do that in the money. Now, that may not always be the case, but typically we'll buy a contract that's in the money. I'll put typically here, okay? And then you're going to sell a contract. Again, calls or puts, they'd be the same for a long call vertical, it'd be two calls. We're going to sell one, and in this class, typically we're going to make those out of the money. And I'll put typically after that because you may see that, you know, I may violate that in the future because it's not a hard and fast rule there on that. But that's typically how they're going to be constructed. And I think I'm going to try and construct the examples I give today in that manner. But I also want to talk about the pros and cons of that. These are directional trades. Last week, we did what's kind of more of a non-directional trade in iron condors. If you're interested, you could always hit up that class if you want to see more about that. But these are I was supposed to say directional. But they also are, I'd say, limited risk. In other words, the reason we're doing a spread is to limit the risk. We could just do a long call, or we could just do a long put, but the advantage, there's pros and cons, the advantage of the long vertical is it's going to limit the risk versus just doing a single option there, okay? In terms of theta and vega, I'm going to kind of talk about these together. It just depends. It depends on the strike prices you choose. You can have positive theta or negative vega when you start out the trade. Negative vega or negative theta when you start out the trade. It just depends on the strike prices that you start out with. But regardless, what happens is you have two contracts. One's going to be positive theta, one's going to be negative vega, one's going to be positive theta, one's going to be negative theta, and they're going to largely cancel each other out. Not entirely, but they will minimize each other significantly. So generally, I would say with long verticals, it's probably less of a consideration than with just like long options or just plain short options there. So what's the max gain on these? Well, the max gain is, let's see, it's going to be your strike width. So how wide you make those strikes, and minus the debit. These are debit spreads, okay? They're going to start off with a debit transaction. The max loss is going to be the initial debit. Okay? I've got about 10 of these, I think. I just kind of listed out. And initial debit, and then I guess I should add, and this will make our compliance people happy, plus any commissions or fees, okay? We don't want to forget about those. That's the max loss on that trade there that we'd be looking at. What about your break evens? How do you calculate, where are your break evens on this trade? Well, in the case of a put, a long put vertical, it's going to be the long strike minus the debit. And in the case of a call vertical, and again, we'll illustrate this all in just a minute here. Call vertical, it's going to be the long strike plus the debit. That's how you're going to figure out where your break-evens are. You can always look on the Thinkorswim, and it'll help show you it that way too. Now here's a key one, and I'm going to go into a lot more depth in a little bit, but probability and reward risk depend on the strikes you choose. Okay, so I'm going to talk about that more in just a minute. Just realize it's hard to say whether this is a high probability trade or a low probability trade, or a reward to risk ratio that's going to be very favorable or not, because it all is going to depend on what strike prices you choose. In terms of exiting these trades, once you're in them, so remember, often we talk about exits in this class, regardless of the strategy of you want your exit, you want to have an idea of when you're going to get out. If things are going well, if they're kind of going sideways or neutral-ish or not moving that much, and if they're going against you. So one is, if it's going against you, you're going to exit on a technical breakdown, or you can use a stop or stop. And I'm just going to say, for example, a 50% stop, okay? That would be 50% of the initial debit, okay? What if things are not going against you much or for you much, or just kind of just progressing there? We're going to exit, we'll say, less than 10 days till expiration, okay? So about a week out maybe till expiration, we'll look to get out on these. And then what if things are going well? Well, we'll look to exit at 80% of max gain. Now, could your rule just be 70% of it? Yeah, you could do it. The 80% isn't written in stone, but that's kind of the rule that we'll use in this class. And one last thing is for money management, we're probably going to go, we'll say risk 1 to 2% of portfolio. Okay, so there we go. Those are the basic rules. Last week, I know you guys asked, well, can you do kind of a screenshot? Yeah, I'm not. If you want to do a screenshot of these, I can't send this out to you. But if you want to do a screenshot of these, you can. These are the rules that we're using in this class. They're not any recommendation that you need to use here on this or not. But that's what I want to mention. Okay. Now, here's what I want to do. I'm going to go and I'm going to move this over, and we're going to go over here. And I want to, you can do these bullish examples or bearish examples. And I was just kind of scrolling through the S&P 100 because I'm looking for more liquid type options. And it's probably no surprise, there's a lot more bearish potential examples if we're going to factor in the trend than bullish examples at this point. But there are still some stocks that look maybe a little bit more on the bullish end of things. So we'll try and give an example perhaps of each. But let me start off with, we'll kind of go with the trend here on this one. And I'm just going to pull up, here's Broadcom. And you can see the trend has been going down. The trend has been going down, and that's what I'm going to continue. Now, in these highly volatile markets, things can change very quickly. Things that were trending down can switch up and go bullish quite quickly. But that we're gonna use the trend here on this. Now, furthermore, remember, I said we can do these as a higher probability trade or not. I want to kind of illustrate that. I'm just going to kind of change my scale here. And I'm going to just draw a couple things here on this. I'm going to say, let's say we did a vertical spread, a long put vertical. The stock's about 147 right now. Let's say we did a 145, 135 vertical. Okay, so I'm going to try and get this roughly close to 145 and 135. Okay, sorry, 145 to 135. So I'm going to do this, and I'm going to say, I'm going to mark this red. And why am I marking this red? Because if I do a long put vertical, 145 to 135, that represents our max loss area at expiration. Okay? If I go to 135, and again, I'll try and get it close, so it's not going to be exact. Okay? We'll call that close enough. This represents, and I'm going to edit this, I'm going to make this color green here. This represents our max. Let me get rid of that low low price bubble there. Okay, just so that's not in our way. This represents our max gain at expiration. Okay, in this case, here's my question for you. If you look at this current price, we're right here. Is this a high probability trade or is this a lower probability trade? Well, look where we're starting out. We're starting out where we're at a max loss at expiration, a max theoretical loss at expiration right there. Okay, if we were to do a 145, 135. We're starting out in a losing position. We need it to move a ways. So in this case, this would be a low probability trade. But when we're doing low probability trade, and you may be going, well, I don't want to do a low probability trade. That's fine. But just realize if you're doing a low probability trade, your reward to risk, I'm just going to abbreviate R to R, is going to be better. Okay? You're going to have a better reward to risk ratio if your trade is a lower probability trade. Whereas, let's think of another scenario. Let's say on this trade, instead of doing the 145, 135, let's say we do a 135, excuse me, let me just move this up, a 155, 145, let me activate that, 155, 145, and is our trade now, remember the stock's right here, right where the end of my cursor is, right there. Is this now a higher probability trade or a lower probability trade? We're basically almost in a max gain position at expiration. So this is a higher probability trade if we were to construct it that way. Now, higher probability trade sounds great. So I'm going to put H prob, that sounds great. But our reward to risk would be worse in that case. Okay, that would be worse in that case. So you're the master of this. You're in control of what your probabilities are and what your rewards and risks are. The reason we're doing a spread is we're going to limit our risk to some extent by having the spread as opposed to just a long option. But in this case, you still have control. So if you are more confident in the move and you think it's going to be a bigger move, maybe you'll emphasize the reward to risk ratio rather than that probability. But if you're maybe a little bit more iffy on the move, but you're more confident it will, maybe at least go sideways-ish, maybe you'll emphasize the higher probability and sacrifice a little bit on that reward to risk ratio. Okay, so I'll try and give you a couple examples of one more a higher probability, lower probability, high reward, and vice versa here on this. So let me just get rid of, let me clear this drawing set, okay? And let's do this. So the stock right now is at 147. What I'm going to do here is I'm going to make this a lower probability trade, but it's going to give me a higher reward on this. So what I'm going to do is if I put the long strike, in this case of long put, closer to that 147 and my short strike farther away, then that's going to give me that lower probability high reward trade. So let me click on trade. Stock's at 147, so I'm going to go to 150, and I'm going to go to, we'll go, I don't know, April 25th. Okay, I'm going to double check my open interest. My open interest seems reasonable here. My bid-ask spreads seem reasonable here. And I'm going to do a 150. I'm going to buy the 150. I'm going to click on that. I'm going to sell the 140. I'm going to hold down my control key. And now I have a long put vertical spread. My debit is 405. If I click on this and click on confirm and send, I'm not going to send it quite yet. Notice my max profit is close to $600. My max loss is about $400. That's a favorable reward to risk ratio. My max profit is higher than my max loss. But I also need the stock to move. My break-even stock price is around 146. Right now we're above that. You can see that right there. And there we go. Okay. So now Joe said, ask a good question. I'm going to answer your question in a sec here, Joe. Okay. But let me just mention this. If our max profit is 595, what would 80% of that be? 595 times 0.8. I'm just using my calculator here on this. $476. So I'll just say 475. Okay, that's going to be our max potential gain on this. Now, let me edit this. Question was, how do we know what the right strike price is? First of all, there is no right strike price. It's how confident you are it's going to make the move. I want, for my lower strike price, remember that represents my max gain on this trade at expiration. So if my stock is at 148, you can use charts if you want to do this. You can use technical analysis to do this if you want. But I want a realistic chance of this going to 140. It does me no good to pick a 120 strike if there's no chance it's going to get down there. Okay, so I want a realistic chance to go there. Furthermore, in terms of this strike, I want it, this is the worst case scenario in terms of at expiration, at least, that's my max loss. I want to be confident it's going to be below that strike. So let's be grounded in reality where you think a realistic move is possible. Given the volatility of the market lately, the bigger moves are probably possible than we would have expected a couple months ago. But so where you think it realistically is. Now, once we're kind of in that range, then you have to kind of decide, do I want to emphasize the probabilities, give myself a little bit of a better chance probability-wise, which aren't guarantees, of course, sacrificing some of that reward to risk, or I'm willing to be a little more aggressive on this trade, emphasizing the reward to risk ratio there. Okay, so that's probably the best I can do on that there, Joe. So that's how I would consider approaching this trade. Of course, there's a lot of different ways to trade. Now, that's where we got right now. Let's go and let's move. Let's talk about these exits that we're putting in. If we're putting this in as the initial trade, I'm going to make this a first triggers OCO right down there. I'm going to put in exit orders. I'm going to put in 2 exit orders, okay? One to get out if things are going well, and one to get out if things are not going so well. Now, you can do this based on the stock price or the option price, the price of our options here. This first example, I'm going to use it based on the option price. I'll give you another example where we do it based on the stock price, but let's do this one based on the option price. We said we want to get out at 80% of max gain. We said our 80% of max gain was $475. Well, if we're entering at $398, what I would do is I'd add that $475 to the $398. That gives me an $873. If I get out of this at $873, then $873, then that would represent my 80% of max gain. I'm going to make that good till canceled. Okay. Now, I'll make this one while I'm at it, good till canceled. What about if it's going against us? What about it's going against? Well, I said, well, we could do it based on the stock price, or we could do the option price. Well, what I'm going to put a stop price here. I'm going to go a stop, good till canceled, and I'm just going to go 50% stop. Okay, so I'm going to put this in at $2, 2.00. Okay, so there we go. That is a trade. This is a first triggers OCO. If I enter the trade, the first part is the entry. In other words, the sell, the orders to get out aren't even going to be active unless this first one fills. And if this one fills, then this one will cancel. Or if this one fills, this one will cancel, because we don't want any lingering exit orders out there. So that's why we do that first triggers OCO. So that's that trade. Now let me go and let me just click on confirm and send. Make sure you review this. This is a debit spread. Okay, this is a debit spread. We're paying $400 up front plus commissions, and then we're going to get out if we hit 873, get out if we hit $2 on that. Okay, so let's go, and I'm going to put this in my long verticals category. Actually, let me just double check and make sure. I just want to make sure this fills, so I'm going to move that up just a little bit. We're going to do long verticals, and we're going to send, and there we go, we filled that. So we have a long vertical in now. Okay, so let's take a look also. So there's the chart. This is just as a reminder, we did where's my, 150, 140. Okay. So 150, 140. If you want, you could even do what I did before. We could say, 150. Didn't mean to do that. Let me try this again. Let me do a little rectangle here. Why is that not giving me my rectangle? Rectangle, 150, we'll call that good enough. That's where we don't want this to go. And we can do another one right down here if we want. And by the way, these stay, if you do these markings on they'll stay until you get rid of them. And let me mark that one green. That is going to be where we want it. That's our target. That's where we want it to go. And you can see why we did what we did. The trend is going down. You know, a lot of bearish sentiment, it seems like, about this. And so that's where we want it to go at expiration. Okay. All right. So any questions on that before I go on? So if I close this down and bring this up tomorrow, these rectangles will still be there. Maybe a good reminder for you on that. And this stop price right there this isn't necessarily exactly what, the stop was put on the option itself. It's not based on this stock price. So we don't know exactly what the stock price is going to be if that stop were to get filled. And same Same on this in terms of our target price, okay, down there. All right, let's do, now, I mentioned, hey, look, it's a lot easier to find bearish examples in the market right now, but it doesn't mean you can't find something that's more bullish. Obviously, this has dropped quite a bit, but for the most part, this has been pretty bullish. And we have our low here. We're above our 50-day moving average right there. Now, is the market going to turn around? I don't know, but let's do just an example trade on Gilead here in terms of the bullish sign there. Okay. Desert Suaro said, hey, I bet there's, how did you add the rectangles? It's just a drawing tool, folks, the drawing tool. So if you can go to your drawing tools down here and go to this one, that little rectangle guy, okay? And then you can draw your rectangle just like that. And then if you want to color it, it comes in that color. You can just right click, edit it, and choose your color right down there to whatever you want, okay? All right, but you know what? I don't want that right there, so I'm going to remove that. Okay, so in this case, here's what I'm going to do. I kind of gave you an example of a lower probability trade, higher reward trade. Let's reverse that a little bit. Let's do a higher probability trade. Sounds good, right? But there's going to be a consequence for the higher probability trade, and that is going to be a lower reward to risk ratio on these. Now, generally, as I mentioned before, the long option we're going to be doing in the money, the short option we're going to be doing out of the money. Obviously, if you do them both out of the money, then we're really going to be emphasizing that reward to risk ratio, better reward to risk ratio, but we're really going to be de-emphasizing that probability, the high probability. Whereas if I do them both in the money, then I'm going to be emphasizing more the probability, but not the low reward to risk. Remember, short options can be assigned early, though, at any time. If I were to do this trade, doesn't matter calls or puts, my odds of early assignment are going to go up if that short option starts out in the money. Okay, so that's just one reason why when we're trying to really emphasize higher probability trades, often we'll shift to short verticals rather than long verticals. Because if I really want that really emphasize the high probability, that short option may be in the money, increasing the odds of the early assignment there on that. Okay, so sometimes that question gets asked: why short verticals versus long verticals? Well, really, if you just look at similar strike prices, usually the probabilities and the reward to risk ratios are going to be pretty similar to one another. But once you really start to emphasize those high probabilities, in order to keep them out of the money, the short options out of the money, to start at least, that's why people may do a short vertical in that case. Okay? All right. So let's do this here. Okay. So we're going to try to emphasize, what's our stock? Our stock's at 107, almost 108 right now. Okay. And this is going to be a call vertical here. In terms of bounce, well, I'm looking for it to bounce up here. Okay. And test those recent highs at least. So if I want to emphasize the probabilities here, I could do something like 105. Look, this is basically in between the 105 and the 110. Okay, if assuming, I don't know what our strike widths are going to be on this. If they're $5 strike widths, if I have a 105 and a 110, okay, I'm just kind of drawing lines where 105 and 110 are. If I choose, and the stock's right in between those two, it's going to be kind of probability 50-50, okay? So, but if I shift it, let me just double check and see what our strikes are on this guy. So we'll go to Gilead, okay? And let me do, I'm going to go out a little farther. Let's see how many, yeah, we got strikes every $5 on here. We could go here and get strikes to every dollar. They're going to be less liquid. Our stock is at 107. Well, let's do this. What if we do like a 100, 110 to illustrate the higher probability trade? This is a call vertical. My spreads are not great on this one, to be honest, but I want to illustrate it. So I'm going to click on the 100 ask price. I'm going to go to the 110 bid price, hold down the control key. Now, our stock right now is at 107.5 roughly. Okay, actually closer to 108. We're a lot closer to our max gain point than our max loss point. So what is our probability? Our probability is going to be higher. What is going to be our reward to risk? It's probably not going to be great. Let's take a look at it. So let me get out of this. Let me confirm and send. And look, reward to risk. Max profit, a little shy of $400. Max loss, a little bit more than $600. Do you see how the reward to risk is worse? Well, but here's the good thing. The good thing is my break even is at 106. Okay? The stock's already above the break even point. So that's good. That's good from the probability standpoint. Okay? Not so good from the reward to risk standpoint. But let's put in some exits on this. Again, I'm going to go to First Triggers OCO. Okay? And I'm going to, this time, instead of placing them, I already showed you placing them based on an 80% of max gain. That was the last trade. You can do the same thing here, or a 50% stop loss. That would be a possibility. But you can also do it based on the stock price as well. So let's say this. This is a bullish trade. What I'm going to say is this. I'm going to say if this is our support level, okay? I'm expecting the bounce here on this trade. If it doesn't bounce, that's no good, but for our purposes. But I'm going to go just a little bit below here. I'm going to say we're going to get out if we hit 104 or less. I'm going to go to that support level and go a little bit below that, okay? If we hit 104 or less, that's going to be my stop. Target price, well, I can just say, hey, look, I want to break, say, to my 115 level, okay? I'm going to get out at 115. You can do a higher target if you want, but that's how we're going to do that. So I'm going to go to trade, and I'm going to say, well, this I'm going to make it a market good till canceled. Okay. I'm going to make this a contingent order. What's a contingent order? What's a contingency? Contingency is if something happens, then the order will place. In this case, we're going to add some rules. I'm going to click on that little gear, and I'm going to say, if Gilead marks greater than or equal to 115, I'm going to get out. Now, I could add a second line item here. That would certainly be no problem. Instead, I have it right down here as a second line item here. So either way you want to do that. I'm going to make that good till canceled. I'm going to click on my gear, and I'm going to say, if Gilead marks less than or equal to 104, I'm going to get out of this trade. I'm going to save that. I'm going to confirm and send. I'm going to make this a long vertical, okay? And there we go. You can make sure you redo these. You guys are probably, if you've watched me long enough, you've seen me mess up in this class. It's a little tough sometimes when I'm teaching in front of everybody and trying to rush through and get through trades. Sometimes I don't take the time to read through these. And I admit it, in your real trades with your real money, make sure you read through these. Make sure they make sense. I'm buying the vertical. I'm buying a long call vertical, okay? 110, 100, 110. I'm going to get out of that vertical if Gilead marks above 115, or I'm going to get out if Gilead marks below 104. And there we go. Actually, let me just Again, see, I just want to make sure this fills here. Confirm and send, put that in long verticals, and we're going to do it that way. Okay? So, yeah, the point is read your order ticket before you send the orders, because it's easy to mess up on those. Let's see. So Joe says, just asking if you went to say a delta less than 40 with probability. Yeah. So good question here on probabilities. Yeah, I mean, like on this trade, we'll stick with this trade since this is the one we want. Our stock's at 107, almost 108. You can look at your deltas here, and remember, we want these to go in the money. Okay, more. That's our goal. So if I pick a higher delta, let's say instead of 47, if I pick a 60 delta, for example, it's a higher probability. That one's actually already in the money in that case, if I did that. If I pick a lower delta, okay, let's say we did a delta, where was your question? So if I pick a delta, Joe, you said, what if I did a delta below 40? That would be a lower probability trade. Don't confuse these with short verticals. With short verticals, we're often looking at deltas that are in maybe the 30 range, maybe 35, maybe 40, but lower deltas or lower probabilities are going to mean a better, that's the probability of it going in the money. Remember, on a short vertical, we don't want it to go in the money. On a long vertical, we do want it to go in the money. So it's just reverse there on that. All right? So I'm hoping that answers your question there, Joe, when that makes sense. Okay, so there we go. There's your trades. Now, there's other trades we could do. I don't have time to go through a whole other trade here, but here's some others that I was, looking at in terms of example trades, and that's all these are, just examples trades. For bullish trades, because as I said, they're not plentiful on the market here. Could you do something like this? Is this looking more bullish than a lot of the market? Yeah, it sure is. With bearish trades, there's, you could throw a dart at the dartboard. You're probably going to get a stock that has a bearish trend on it right now. But let's just kind of review. Let's just look at the market as we've seen. So going to what we started out, we're right near the bottom of the day right now. That's not a bullish sign right now. Again, if you're a bull, what bulls like to see typically is we'd want to see a candle that looks something more like this for the day than what it is currently. Now, we still have an hour to go in the trading day, so hopefully maybe a late day rally, but right now, we're not seeing it. Right now, this is what we're seeing. Earlier, I was saying, hey, look, it's looking a little bit, well, it did exactly. In fact, right when I mentioned it, right at the top of the hour, is when it turned to, I think it listened to me, folks. That's what did that. So there we go. And Chris said, yeah, not much on green on the heat map there today. That's true. So, hey, I want to thank you today. This is kind of the second one in our series. This is long verticals we covered today. Next week, we'll go a little bit more complex. I think planning on doing butterflies next week, probably. But I encourage you to subscribe to this Trader Talks channel so you don't miss future content. You don't miss Barb's classes. Make sure you follow Barb on Twitter, by the way, on X, at Barb Armstrong CS, my X handle, at Brent Moore CS. Barb posts a lot of good stuff out there. She's also on the road quite a bit. So make sure if she's in a town near you, you go up and you say hi to Barb at the workshops. She's wonderful. She also teaches a trading a smaller account webcast, which I would highly recommend as well. Coming up next, we got ThinkScript Studies. Make sure you check that out. Mike Fairborn teaches that class. Everyone have a great rest of the day and a nice weekend, regardless what the markets do. Have a good weekend. We'll see you later. Bye-bye, everybody.